ได้ครับ thank you everyone. So sorry for the delay. This is Chris Woods from Jefferies, as you all know. He's our superstar global strategist. Chris will be here talking about his latest report and his view, obviously, on the global.
What are we doing on the chart? Okay.
So you can press that to move up and down. Yeah. So the screen is shared, Chris. So everyone can see your slides.
Oh.
So you can yeah.
How do I move the slides?
So press down.
Doesn't work.
No,
hello.
Press
It's not working.
A second. Oh, okay.
Now it's working.
Yeah.
Okay, so that's awesome. Okay, hello everybody. I'm going to kick off by going through the bullet points of my most recent Asia Maxima quarterly, which came out for the start of Q3, just to give you the big picture view. And then we can jump around some of the charts. First point, investors have increasingly given up on the US recession forecast, but classic macro signals continue to suggest a coming US downturn. Still, monetary policy will work with an even greater lag than normal because of the role played by unregulated shadow banking in this credit cycle and the resulting lack of preemptive provisioning pressure from regulators. Second point, the incentive for everyone involved in the formerly booming world of private lending and private equity is to delay price discovery for as long as possible. The credit risk in this cycle in America is with lower rated US corporates rather than US households, with an estimated $4.6 trillion of exposure in leverage loans, private loans, and high-yield bonds. Commercial real estate is likely to be the area where the commercial bank-funded world connects with the privately funded world. The US stock market has become even more vulnerable to the earnings downgrades which would come with a recession following the rally of last October's low. Still, the tech sector has a new powerful narrative to celebrate in the form of AI, which creates the potential for investors in certain high-profile stocks to look through economic downturns. The silver lining for the equity asset class of any evidence of a downturn, most particularly in the US labor market, remains a likely fudging of the Fed's 2% inflation target in the context of continuing sticky core inflation. The resulting sell-off in Treasury bonds will lead to rising focus on the growing cost of financing America's huge fiscal deficits. If the rising risks of recession in America and the Eurozone are the result of still ongoing monetary tightening by both the Fed and the ECB, inflation remains structurally lower in Asia. This reflects Asian central banks' orthodox monetary policy during the pandemic, compared with the MMT-like policies implemented by G7 central banks. This should lead to a lower cost of capital for Asia going forward. On China, inflation is the last problem to be concerned about in China, where a renewed downturn in property sales last quarter has raised concerns that the PBOC is pushing on a string in the context of continuing monetary easing. The possibility of more aggressive stimulus, both fiscal and monetary, from Beijing is rising, even if that is contrary to the deleveraging policies pursued in recent years. And finally, gold and Bitcoin remain essential hedges against the potential for renewed policies of currency debasement in the G7 world and the related structural return of inflation. So that's the view at the start. That was my view at the start of the quarter. It's not really changed much since. It seems to me, in recent months, I've begun to conclude that from a market psychology standpoint, it's almost as if the market needs to give up on a recession before a recession in the US can happen. In the case of the Pacific GDP forecast of Jefferies US economists at the start of this year, the forecast was that the recession would only kick in the second half of this year. The clearly, it could be even longer than that. But my base case is still that at some point this monetary tightening cycle will lead to a more pronounced economic downturn. Though another clear point this year is that very easy fiscal policy has been a support to the US economy. I'm just going to jump around some of the charts, but by key point, the key reason why I'm still of the view that a downturn is coming at some point is the ongoing collapse in M2 growth in America, which you can see on this chart 3, because M2 is declining at an unprecedented rate, but it's important to understand it's declining from a very high level. The reason we've had this inflation issue in the US and other G7 countries in the past 2 years is because of the aggressive monetary easing triggered by the pandemic in the G7 world, which you can see in the explosion in M2 growth in 2020 in America. That's the cause of the fundamental cause of the inflation. The supply chain bottlenecks were aggravators to it. The reason Asia hasn't had the same inflation problem is because you never saw the same degree of monetary easing, and that's why Asian emerging market bonds have outperformed G7 government bonds. But now, well, that was the history. That's why we had the inflation. The key point now is M2 is coming down hard, growth falling. It's come down dramatically, but it's coming from a very high level. So the base was very high. This is why this next chart I got on the screen now is probably the most important chart in the world right now, the most important chart in this presentation. This is the MT2 to nominal GDP ratio, which is the flip side of the normal velocity ratio. And what this chart highlights is the line's coming down hard, but it still remains above trend. So back when monetary expansion peaked in the second quarter of 2020, this ratio was 27% above trend. It's now just over 4% above trend based on second quarter data. It was 7% above trend based on first quarter data. So it looks like in the next few quarters it could go below trend, and that starts to happen. Then then in that situation we start to get the liquidity pressures really kick in. So monetary tightening in that sense does work with a lag. Meanwhile, the yield curve, inverted yield curve, is another classic recessionary signal we've been looking at in recent months. This is an interesting historic fact. In the last 8 recessions, there's been an average of 11.6 months, 354 days, between the first sign of an inverted yield curve and the onset of a recession. And that's the average. It can take longer than that. So another example of the lags. Federal Reserve balance sheet expansion has begun to contract again. But earlier this year, we had the Fed providing liquidity support to the banks because of the regional bank issue. And that caused the balance sheet to expand. So in that sense, while the Fed has been raising rates this year and been talking tough, the Fed has also done 2 major policy easings, which are often ignored in the commentary, because this whole Silicon Valley Bank affair was the latest example of how little tolerance for pain US authorities have, I should say. First, they effectively bailed out all the depositors in Silicon Valley Bank, even though I think about 85% of them were above the deposit insurance limit. And the second point is the Fed's provided liquidity to these regional banks and valued their collateral at par, not at market. So these are two acts which basically were very supportive. They were easing policy, even though at the same time they were raising rates. On the banks, the regional US banks, the regional banks lost deposits after that whole situation. Money poured into money market funds, as you can see in this chart. Recent weeks, the good news for regional banks is they've begun to see an increase in deposits, presumably because they'll be offering higher rates, because that deposit outflow was clearly created big risk for them and has caused the tightening in lending standards. Money's gone into the US money market funds, which have 32% of their assets invested in the Fed's repo facility, originally set up in 2013, which is now paying 5.3% to those money market funds. So that, in a funny kind of way, is disintermediating the US banking system. Meanwhile, the macro significance of the regional banks is they have about 70% of the total bank exposure to US commercial real estate, which is around 2.9 trillion, and US commercial real estate right now faces a lot of stresses in terms of empty buildings. So the important point to know about that is that there's a $1.5 trillion refinancing schedule on commercial real estate loans in the next 2 years, which was described to me recently when I was in America as a slow motion train wreck. But again, it's a slow motion train wreck, so it can take time to work its way through the system. Another reason for the lags. Meanwhile, in my view, the credit risk in this monetary tightening cycle in America is more likely to be with the lower rated corporates than with US households, whose savings ratio is comparatively high by historic standards. So normally when you have a monetary tightening cycle, the problems emerge in the area which has been enjoying the biggest boom. So the question is, in the cycle which is basically run in America in the monetary easing cycle, which basically ran in America from 2009 with the onset of QE up till March 22, when the Fed started tightening. The question is, who enjoyed the biggest boom during this period? Who most profitably, ruthlessly exploited the zero rate era? In my view, the answer to that question is private equity and private lending. So logically, this is where the biggest boom should be. It should be where the credit problems emerge. But the key point to understand is that unlike conventional bank-funded world, this area is essentially completely unregulated. So there's not going to be the normal preemptive provisioning pressures from bank regulators if there are problems. Similarly, everybody in this private lending, private equity world is incentivized to delay price discovery for as long as possible. So if problems do ever emerge in this world, it's going to come as a surprise to markets, regulators, and the central banks. So this is something slightly unique about this cycle. So my view is very simple. It's either going to be basically not a problem at all in this area, or there's going to be a very big problem, and that will depend on whether there's a recession or not. But there's three pockets of issues in this area. There's the high yield bonds, so-called junk bonds. I think there's about 1.5 trillion in this area, but this is the least risky area because this is where corporates have refinanced their debt, termed out their debt, and that's why this chart doesn't show a big rise in credit spreads. The risks will only kick in here when they have to refinance. Then a more risky area is leverage loans. These are linked to LIBOR, so the cost of servicing leverage loans goes up with Fed tightening. And leverage loans are usually employed by private equity firms when they do these buyouts, leverage buyouts. Banks lend they lend the money, but usually these leverage loans are packaged into collateralized loan obligations. But the interesting point about the leverage loans is, based on what I've been told, in most cases, the interest rate risk has not been hedged. So there are definitely growing problems in this area. But if you're a private equity firm employing a leverage loan to do a leverage buyout, the key point to understand that the debt taken on in that leverage loan is not sitting on the private equity company's balance sheet, is sitting on the balance sheet of the company they bought. And that's probably a good explanation why they didn't hedge the interest rate risk. The other area, which I think has not been stress tested in a recession, is the private lending area, which is again another 1.5 trillion or so. And private lending has been a booming area, because what happened post 2008, with the banks heavily regulated, smart money moved in to exploit the vacuum left by the banks and set up this whole private lending industry grew. Now, I think this is a very good area to invest in post 2009 because some of the best credits would have been available. But 15 years on, this area has been booming. Oftentimes, private lending funds deploy leverage, and well, they always, I think, employ leverage. And we haven't stress tested this area in a downturn, but again, it's essentially unregulated. So all this is why it can take longer for problems caused by monetary tightening to become visible. Meanwhile, from a macro standpoint, the surveys are showing a tightening of, banks becoming more cautious about extending credit, and borrowers becoming more cautious about borrowing, be they corporates or consumers. So this chart 18, the green line is a measure of both willingness to lend and willingness to borrow from central bank Fed surveys. So this green line has been going down recently. That is historically correlated to the black line, which is US real GDP. But so far for now, we don't see the normal correlation between the green line and the black line, i.e. the lending standards are getting more cautious, but the economy is not following. Loan growth, however, has clearly turned down in the US. From a stock market standpoint, I think the market this year has got a new growth driver from tech. Tech has a new story in the form of AI, and that definitely has given a bid to the big tech stocks, not just NVIDIA. But what this chart also highlights, that if there is a recession in the US, there's significant earnings downgrades risks, since the gray area in this chart shows what happened to earnings in the last 4 recessions. Inflation is clearly coming off. There are a large part of, significant part of the decline in inflation this year is related to energy. Core PCE is probably the most important measure. It's the Fed's favorite inflation target. It was 4.1% year on year in June, so it's down significantly, but it's still well above the Fed's 2% inflation target. The issue for me right now with Fed policy, because the Fed could easily have stopped tightening 2 or 3 meetings ago. Fed could quite easily have argued that they've done a lot of tightening already. They could have argued inflation expectations remain well anchored, and they could have said, we just want to wait and see what's the impact of all this tightening because of the additional lags in the system. But because Powell is trying to restore his and the institution's credibility, he's chosen to keep tightening despite all these classic recessionary signals like inverted yield curves. And he's put a lot of emphasis on the labor market, even though most economists, obviously Powell's not an economist, most economists would view the labor market as a lagging indicator. So the question then becomes, do we suddenly, what does the Fed do if in coming months we suddenly see weakness in the labor market at a time when inflation's still above the 2% target? For now, we don't, obviously, I've got the payroll chart on 22. There's a slowdown, but there's not real weakness. In an environment where payroll suddenly turn negative, say, my personal opinion is that that will then create the interesting situation where the Fed's put in a position where it has to choose between its 2 mandates, employment and inflation. And in a world where there'll be growing focus on next year's US presidential election, my base case is the Fed will then start to prioritize employment mandate over the inflation mandate. And of course, the PC is still significantly above 2% at that point. That will then likely be interpreted by markets as a signal that the Fed is not going to enforce its 2% inflation target aggressively, and that may raise expectations of inflation in the US ending up structurally higher, say in the 3-4% range, in which case such a signal would be good, positive for equities, particularly cyclical equities, but negative for treasury bonds, government bonds. The other point, I think, and so on the employment market, I think the key area is the small businesses in America, the SMEs, because the reason our economist was not expecting a recession to come until the second half of this year is because the SMEs ended 22 in a strong position. And the SMEs employ, by the way, most Americans. And the reason the SMEs ended 22 in a strong position is because they were beneficiaries of the big pickup in inflation, because the big pickup in inflation translated in the economic terms to a big rise in nominal GDP growth, which for domestically focused SMEs means a big pickup in revenue growth. So their revenue growth, based on our economist numbers last year, rose more significantly more than their wage costs. The wage costs lagged. So they basically saw record profit margins according to her data last year. So the last thing they were thinking about doing was laying off labor. In fact, they had a hard time getting labor to work in America because people got used to working from home and they'd received transfer payments from the pandemic. So there's record profit margins last year for small businesses, but this year it started to go the other way. Nominal GDP growth is slowing because inflation's coming off. The employees are trying to play catch up on the wage growth they missed out on last year. And third, but perhaps most importantly, for those SMEs who borrow, they're borrowing at the short end. They can't lock in bond deals like big corporates because they don't have access to the bond market. And as you can see on chart 24, their cost of borrowing is increasing. In June, the average interest rate paid based on the monthly NFIB small business survey was 9.2%. So I just think this is a matter of time for this squeeze to kick in. Meanwhile, going back to the Fed, and if the Fed does fudge that 2% target and bonds will sell off, that will then confirm what the signal sent by this chart. This chart, very important. It's the log scale chart of the 30-year Treasury bond yield since 1980, when the bull market in Treasury bonds began, when Paul Volcker crunched inflation. And you can see, and since the pandemic, we've broken above that trend line in yield terms. If we get a Fed fudge before we've gone through that trend line on the downside, that will, for me, confirm that we've entered a bear market for Treasury bonds. And you start to get the 10-year trading between a yield of 4 and 5%. You'll get growing focus on the rising costs of servicing this huge US fiscal federal debt, which of course is one reason Fitch downgraded the US sovereign credit rating last week. So that's the view on the US. Europe, we've seen actually as dramatic a tightening cycle in the Eurozone as the Fed, but there's been one big silver lining from a European stock market standpoint of this tightening cycle, and that is that the banks, big part of the European index, were liberated from what I view as the insane policy of negative rates. That's been very good for banks' net interest margins, and that's one reason why European stocks performed okay in the first half. But as the year progressed, and like US, there's got to be a good chance that we have seen the last of the rate hikes in Europe. In some ways, there might be a better chance of that in Europe than America, because you're already seeing lending standards tighten in Europe. as the impact of the higher rates start to kick in. Eurozone loans to the private sector have turned down. So I think both in America and Europe, concerns about recession will be growing in coming months. Meanwhile, a joker in the whole situation, potential joker, is crude oil. I've been bullish on energy stocks for some time. 21-22, energy was the best performing sector. First half of this year, energy did not work. Oil price was surprisingly weak, although it started to pick up again, the oil price in July. Why was oil weak in the first half of this year? Because it's not like the US entered recession. If you watch the talking heads on Bloomberg TV, you'll be told the key explanation for oil price weakness has been the weak Chinese recovery. But actually, if you look at the actual data, oil demand in China is back above pre-pandemic levels. So I think the key reason for the weakness is the chart, what you see in chart 32, and this hasn't got the attention it merits, and that is that the US last quarter continued to take oil out of its SPR, Strategic Petroleum Reserve, even though earlier this year it said it was going to do the precise opposite. In the very recent weeks, they have stopped taking oil out of the reserve, and that's coincided with the renewed oil price strength. So oil does have the ability to mess things up for the central banks, because if it rises here, inflation expectations will pick up, and that will make it harder for the Fed to stop tightening. So I think oil has become important again of late. Meanwhile, going to Asia and emerging markets, the key dynamic in recent years is best captured in this chart. The green line shows the significant, if not dramatic, outperformance of local currency government bonds in emerging markets relative to the global government bond index. That's the green line. But the black line shows the opposite. That's the ongoing underperformance of emerging market equities relative to world equities, which is caused driven in part by the weakness of China, in part by the renewed rally in the big tech stocks this year on the AI theme. Best story, best case for emerging market equities is the US downturn does come, Fed starts easing, dollar starts weakening, but unlike 2008, emerging market economies don't get so badly hit, and they rally on the weaker dollar, lower rates. But the part of emerging markets most geared to such an outcome would be Latin America, most particularly Brazil, which has the highest real rates. This chart just shows the difference in monetary growth just shows why the different money supply growth numbers. It's just showing why there was more of an inflation problem in G7 world than Asia. 36, Asia is cheap, but Asia's been cheap a long time. The issue is whether it's a value trap. That value trap issue is clearly most relevant for China. I won't go through, happy to answer questions on my portfolios. I won't go in detail with them here. I've got two Asia ex Japan portfolios. One is kind of more for people with the index tracking restraints. On that one, I haven't got, running China neutral because it's got cheap valuations and there's growing easing noise. But on my long only Asia ex Japan portfolio, where I'm not worrying about benchmarks, deviations from benchmark in the near term, there I'm structurally positioned how I want to be, and I'm about 45% in India and only 15% or so in China. And India remains, as it has been for the last 20 years, my favorite structural story in Asian equities. In fact, it's my favorite structural story, not just in Asian equities, but in global equities, which is why I have, that's performance portfolio. That's why I also have about 25% in India in my global portfolio. Anyway, I'm happy to answer questions later this time. I'll just discuss Japan now. Japan's become a fashionable market last quarter, partly because foreign money, apart from dedicated emerging market money, has now considered China uninvestable. And for that reason, they're not investing in China and they're starting to invest in Japan. But the macro story in Japan is incremental tightening by the BOJ. 2 weeks ago, we had a further adjustment in the yield curve control. It can now theoretically trade up to 1% on a 10-year JGB. That is an interesting move because based on my discussions in Tokyo earlier this year, there's at a level of 1% on the 10-year JGB and 2% on the 30-year, those are the levels of return where it starts to make sense for Japanese institutions like life insurers to repatriate their capital back into Japan because they can now earn a yen yield, which allows them to meet their asset liability requirements without having to buy bonds offshore on a hedge basis. So I think that's something to be aware of. That capital repatriation should trigger upward pressure on the yen. Though the weird thing about the BOJ move nearly 2 weeks ago, it should have been yen bullish, but the yen declined. I got no idea why that happened. The argument, the post facto rationalization by talking heads is that the move was discounted and was reflected in investor positioning, but I don't believe it. I don't believe the consensus was expecting a BOJ adjustment at the last meeting. This next chart shows that the BOJ had to aggressively buy JGBs late last year to defend its yield curve control. In a world where the Fed fudges a 2% target, the bond market starts selling off again big time, that pressure will return. So in that sense, it's good that the BOJ is giving itself more room in terms of the YCC. Core CPI remains well above the 2% target in Japan. The BOJ line is a bit cautious on this inflation still because a lot of it is driven by import inflation, which is now declining. That's true, as chart 44 shows. But there is another fundamental development which the BOJ will be well aware of, and that is that last year, inflation expectations rose significantly in Japan. This chart on 45 relates to corporate inflation expectations, a very dramatic pickup given the long-standing deflation in Japan. And the fact that corporates now think inflation has come back explains why they finally paid their employees a more significant wage hike, the most significant wage rise in this spring's wage round for 30 years. So given the way Japan works, that reflects a consensus amongst corporate Japan that inflation is back. Whether that's right or not, fundamentally, it's clear they think it's come back. And that's why they finally raised wages, whereas for the previous 10, 15 years, former Prime Minister Abe had been trying to get them to raise wages, but they never did, never really did. So that does create hopes of a sort of self-feeding pickup in domestic activity. Logically, if you think inflation's back, you should allocate money out of yen fixed income into Japanese equities. But that asset allocation move has not yet happened in Japan in the context of most big domestic institutions. They basically have reduced asset allocation to their own stock market since 1990, but they already should have made that asset allocation switch when Abe launched Abenomics, because you've had a 254% outperformance of the topics on a total return basis since November 12, 2012, which was basically when the market started to discount much more aggressive easing policy from the then incoming BOJ Governor Kuroda. Last quarter, though, the big outperformance in Japan was not about domestics, it was about foreigners. As this chart 48 shows, you had record foreign buying of Japan by foreigners. record foreign buying of Japanese equities. And the whole story there is the corporate governance reform, rising share buybacks. This is not a new story. It's been going on for some time, but there's an added dynamic to it because earlier this year, the Tokyo Stock Exchange launched a schedule where if corporates don't meet certain return criteria by, I believe, sometime in 25, they risk delisting. So that name and shame dynamic is quite powerful in Japan, but very powerful. I'm positioned in Japanese financial stocks in my Japan portfolio because I'm expecting sooner or later a move out of negative rates. China, very difficult market for dedicated emerging market money because China is a big part of the benchmark, but global money, as I said earlier, has deemed China uninvestable. And I think global money will only come back into China if there's real outperformance, which creates real pressure from underperformers to come back in. And clearly that's not the case in that right now. So we had a big rally off the lows, but then we turned down again. Growing concern that China's pushing on a string. Monetary easing, there'll be monetary easing, monetary policies late 21. But obviously the COVID lockdowns undermined a lot of the easing efforts last year, be they monetary or fiscal. And this year with the reopening, still credit growth has turned down again. Huge growth in household deposits last year in China because of the negative impact to the consumer of the lockdowns. So the Chinese have turned temporarily Japanese. And the risk, which is a real one, but I'm not convinced that it's the case yet, is have they turned permanently Japanese? In my view, it's too early to make such an extreme conclusion, but it's quite clear that they turn temporarily Japanese, as this chart of surging household deposits makes clear. They can definitely cut rates more if they want to, because inflation is basically negative, but they don't really want to cut rates aggressively because that basically creates potential of capital flight, given it would widen the rate differential with the US dollar. Key chart in China for me is this chart 57, which is residential floor space sales in the 30 biggest cities. And this has been a bit of a fake out both for the market and for me, because in the first quarter, actually, what positively surprised me, and indeed the market, was the pickup in property sales was greater than most people anticipated. But when I was in China in March, it was also clear from conversations that this pickup in sales was almost primarily accounted for by existing property owners upgrading, and that upgrading demand was pent up because of the lockdown. So what clearly happened is by the end of Q1, that upgrading demand had largely been met. And then but there was no follow through in the second quarter. But the impact to sentiment was almost more negative in the 2Q because of the pickup in Q1. And the downturn 2Q looks worse on the chart because of the base effect than it is on a month-to-month basis. But the renewed downturn has caused people to abandon hope of a pickup in property sales, also not property sales, of land sales, and that has then people give up on a revival of land sales after the big collapse in land sales last year, given the lockdowns. Then that raises the issue of the problem of local government finances, and you've got growing discussion on what the government can do about the local government debt issue. So this is the sort of dynamic we're in China, but it made sense for the market to rally after the most recent Politburo statement, because in the Chinese government, it has now admitted there's a problem with a lack of confidence. And you're seeing a lot of micro measures to address this, but they clearly want to avoid, if they possibly can, big bazooka stimuluses. So for now, I'm running China neutral. It's cheap. If you're an income fund, there's huge dividend yields, but clearly the there's a risk of it being a value trap. That's my China portfolio. Taiwan and Korea outperformed first half of this year. This is a classic example where investors turned out to be right for the wrong reasons. They bought Taiwan and Korea start of this year because the semiconductor stocks had been smashed last year. The narrative was that what I call legacy tech will pick up in the second half by the middle of this year. Actually, during the course of the first half, estimates of PC sales, smartphone sales were further downgraded. And in my view, sooner or later, they'll also downgrade estimates of server demand. But if you owned the big stocks, TSMC, Samsung, Hynix, they still paid off in the first half because once Microsoft had purchased GB Chat, the AI at the end of January, the AI theme entered the markets and these stocks rallied as perceived AI beneficiaries. In terms of export growth, Korea and Taiwan, we don't have convincing evidence of an upturn as yet. Just go very quickly. India, as I said, my favorite market. There's an ongoing monetary tightening is over. Like much of Asia, Southeast Asia particularly, the only thing stopping central banks from cutting rates now is the concern that they undermine their currencies vis-a-vis the dollar because there's a risk the Fed has more rate hikes. So they're likely on hold through to the end of the year, be they Indian Central Bank, Indonesian Central Bank. Where this chart shows growing hopes that we could be commencing a private sector capex cycle in India, which would be very bullish and a follow-on from the residential property upturn, which has commenced. We're now in the third year of that. That's rising property sales. So the Indian story looks very good. The valuations are high, but not stupidly high. Biggest concern for India short term now is the market's already done very well, as you can see in the performance in recent months of my Indian portfolio, which is in rate sensitives like banks and property. Chart 79. But I think we've got a bit of time for Q questions if there are any. I'll stop there.
ครับก็เดี๋ยวมีคำถามก็แชทพิมพ์ในแชทได้เลยนะครับหรือว่าก็ถามเปิดไมค์ถามได้เลยครับมีคำถามฮะyeah so what factors need to occur
well actually I reduced the Thai weighting. I was overweight going to the election because I thought the market would rally if the Thaksin party won convincingly, because I think that would have encouraged expectations of more proactive policies towards the economy. But when the result came as it did, I reduced the weighting because obviously there was a risk that the result wouldn't be acceptable to the establishment. And right now I'm underweight Thailand, and I'm waiting to see what happens on this political development. So I think we have to wait and see till we see the outcome of that, which is clearly still an unfolding story.
Hey Chris, just to follow up on that question, have you been have any investors that you met talk about Thailand at all, and what has been the impression?
Oh, you mean foreign investors?
Yeah, foreign investors.
Yes, foreign investors, obviously a lot of them bought Thailand last year. Well, there's two areas of focusing on. One is obviously that the mainland tourists have come back, but not on the scale of pre-pandemic. And so the question is, one, how long will that take to kick in? And whether there's an interesting issue of whether this mainland tourism thing is being held up just by administrative things like getting passports and visas and increasing international flights, which is definitely an issue. But also, is there is the Chinese government not keen to have masses of people go abroad? So I think there's two issues there. And then foreigners involved in foreigners are interested in the politics. Yeah, the ones who know Thailand ask about it. The politics, yeah.
the Chinese economy do you think that has also contributed to the lackluster Chinese tourist arrival in Thailand up until now, or you see more as administrative?
No, yeah, because the domestic travel in China has been okay. This has not been an area of, it's not like Chinese are not traveling. So I think that there's definitely an issue that it takes time to get visas, passports, and it's definitely an issue that there's not as many flights as there were. But then the other question, which I really don't know the answer to, is to what extent is these delays, is it deliberate policy on the part of the Chinese government because they don't want to encourage huge outflows? There's a difference of opinion on that. But it's not like there's no Chinese tourists. So I think the logical thing is the longer time goes on, the more it should pick up. But there's not, I think I'm right in saying, you know, the number of flights are much less than pre-pandemic.
So another question, what's your opinion about the US dollar? Could the US dollar eventually have zero value, as many people have said?
Yeah, well, my base case is the dollar has put in a peak last year. Zero value is extreme, but there's definitely a move away. You know, countries are wanting to trade less in dollars. As you can see, the most recent example of that is an agreement between Brazil and China. And it's also clear that central banks are reducing exposure to US Treasury bonds, including the two biggest holders, Japan and China. And I think one big negative thing for the dollar happened in the long term, happened last year on the outbreak of the Ukraine conflict, when the US froze a significant portion of Russia's foreign exchange reserves. Because that was a big shock, I think, to many people. And so what you saw in sort of second quarter, you saw a big pickup in central banks buying of gold.
Okay, next one is, what's your opinion about Japanese equity in terms of weakened Japanese yen? In your opinion, why foreign investors have record buy in Japanese equity? So I guess
well,
it's
yeah,
a mismatch.
Yeah, no, you know, people think the Japanese stock market can only do well when there's a weak yen. That's been true in recent, you know, post the bubble, for most of the post-bubble period. But of late, I think that correlation has broken down. So in my view, in a world, you know, my view, there's a big Japanese rally going forward. It's more likely to coincide with a stronger yen, because it's likely to be about domestic institutions reallocating money from offshore to Japan and reallocating domestically into equities. So I don't think you need to have a weak yen for the Japanese market to perform. And but I think one reason why foreigners had record buying in Japan last quarter is because they stopped buying China. When I say they, I mean global money, not emerging market dedicated money. So I think they stopped buying China because they decided it was uninvestable. And they suddenly focused more on Japan, and they learned more about this corporate governance reform story, which, you know, which has some real substance to it in terms of rising share buybacks, rising payout ratios.
Another question. In your presentation, understand that India is best positioned in this regime. Can I have your view on South Korea equity outlook relative to Taiwan based on cyclical upturn and relative valuation?
Yeah, I'm more weighted in Korea than Taiwan. So I was so to me, yeah, I prefer Korea to Taiwan. But that's partly because I think there's an issue though on Korea and Taiwan of whether, which I'm really not a tech expert, but to me, both Korea and Taiwan face the risk in the tech stocks of a downturn in server demand, because people are going to be cranking up spending on AI servers. So the question is, do they cut spending on traditional servers? So this is a very tricky issue, because these stocks are geared into the future AI story, but right now, as the TSMC's latest results made clear, tech is in a downturn, legacy tech. So I think it's tricky. But if I was only going to own Korea or Taiwan, I think I'd own Korea because I think there's more issues. Well, first of all, people are divided. Which is the bigger AI beneficiary, Korea or Taiwan? I've heard people argue both. But in the case of Taiwan and TSMC, you have these complicating factors that they're now having to produce more and more offshore for political reasons, and that's, as their statements made clear, is much more expensive. So I think the TSMC business model is going to be much more complicated going forward.
I think we have time for maybe one or two more. So next one is US equity is somehow 10% from record high with 5% interest rate. Do you think that the situation is sustainable and US equity have more upside or downside?
Now, in my view, that the base case is a recession. I don't think it's sustainable now. And I think actually I'd be surprised if there isn't material equity weakness. You know, normally the weak parts of the year, you know, in seasonally weak part of the year for stock markets is September, October. So if I've been lucky enough to be fully invested in the S&P all year, I would be hedging it like now. I would have the hedge on by the end of August. Yeah.
Yeah.
Because even if there isn't a recession, it's pretty fully valued.
Okay.
Vietnam market. Yeah, I think the Vietnam market is. See, people haven't invested in Vietnam already. I think this is a good chance. The last few months have been a good chance to re-enter Vietnam, because we had a real liquidation in Vietnam last year, which was triggered by not like a macro disaster. It was driven by a combination of a corruption crackdown coinciding with a central bank tightening. And the thing about Vietnam, unlike Thailand or other Southeast Asian markets, my understanding is there's hardly any domestic institutions in Vietnam. It's foreign investors and retail. So when the retail sells, there's no institutional support. So the market, you get a big correction. So yeah, I think this is a good opportunity for long-term investors to re-enter Vietnam.
Comparing Thai market with the countries around us, Asia market. Which is interesting.
No, in terms of Southeast Asia, ASEAN markets, there's no doubt the market which has seen the biggest flows and the most increase in interest is Indonesia. Indonesian market. So that's definitely the market that's had the most increased interest, and I would say in the last 2 years, but the foreign positioning in Indonesia is very concentrated, I would say, in the bank stocks.
Okay, I think we probably need to go. So if you have any other questions, just you can email sales or contact sales, and then they can pass on to me, and I'll be with Chris until later this afternoon, so I can pass on the question to him. Thank you very much for heading the event. Thank you, Chris, for hosting, and yeah, and let us know if you have any other questions. Thank you.
Thank you.
Thank you.
You can keep